Something is breaking in the global financial system right now, and most people don't see it yet. Banks look stable on the surface, bond markets look orderly on TV, and precious metals seem quiet. But underneath, pressure is building in a way we've only seen a few times in history. This is one of those moments where everything appears normal, right before it isn't. What's happening between global banks and the bond market is quietly setting the stage for a shockwave that could send gold and silver sharply higher, faster than most investors expect. If this video resonates with you, make sure you hit the like button and subscribe to the channel. It helps get this message out to more people, and it ensures you don't miss what's coming next, because the signals are getting louder by the week. Right now, banks around the world are facing a problem that can't be solved with simple headlines or short-term fixes. Years of near-zero interest rates encouraged banks to load up on government bonds, long-duration debt, and so-called safe assets. On paper, these bonds were low risk. In reality, they were only safe as long as interest rates stayed low forever. That assumption has now been broken. As rates rose aggressively, the value of those bonds collapsed. Banks didn't necessarily sell them, but the losses are still real. They're sitting quietly on balance sheets, labeled as held to maturity, which sounds comforting but hides a dangerous truth. If depositors demand their money back, those bonds must be sold at a loss. And once confidence cracks, withdrawals don't happen slowly, they happen all at once. We've already seen what that looks like. Banks that appeared healthy just weeks earlier suddenly collapsed when depositors rushed for the exits. And while officials rushed in with emergency programs, guarantees, and reassuring press conferences, they didn't fix the root problem. They simply bought time. Time is not the same thing as stability. At the same time, the bond market itself is flashing warning signs that most people ignore because they sound boring. But bonds are the foundation of the entire financial system. When bond markets break, everything above them starts to shake. Yields moving violently, liquidity drying up, and buyers stepping back are not normal conditions. These are stress signals. Governments are issuing massive amounts of new debt to fund deficits, bailouts, and rising interest costs. Central banks, meanwhile, are pretending to fight inflation while quietly worrying about financial stability. They are trapped. Raise rates too much, and banks break. Cut rates too fast, and inflation reignites while currencies weaken. There is no clean exit from this situation. This is where precious metals enter the story. Gold and silver don't depend on bank balance sheets. They don't require counterparty trust. They don't care about quarterly earnings calls or policy statements. Historically, when confidence in banks and bonds weakens at the same time, capital looks for safety elsewhere, and it tends to move suddenly, not gradually. What most people miss is that precious metals don't need a full-blown crisis to move. They only need a shift in perception. The moment investors realize that bonds are no longer the risk-free asset they were promised, the mental framework changes. That's when portfolios get rebalanced. That's when insurance becomes urgent instead of optional. Silver is especially interesting here. It's small, thin, and highly sensitive to capital flows. A relatively small amount of money entering the silver market can cause outsized price moves. This isn't theory. We've seen it before. And yet, silver remains deeply underowned, underallocated, and often dismissed as a secondary metal. That dismissal is exactly what creates explosive upside when sentiment flips. At Silver Reset, we focus on what happens before the headlines change, not after.
And right now, the disconnect between risk perception and actual systemic stress is growing wider. Banks are under pressure, bond markets are strained, governments are boxed in, and precious metals are still being treated as if nothing is wrong. Another layer to this story is confidence. Banking is built on confidence. Bonds are built on confidence. Currency systems are built on confidence. When people trust the system, everything works smoothly. When they don't, even the strongest institutions can unravel quickly. Confidence doesn't disappear slowly, it snaps. We're already seeing subtle signs of that snap. Quiet mergers that don't make sense economically but are framed as strategic. Emergency lending facilities quietly expanded. Regulatory language shifting from unlikely to monitoring closely. These are not the words of a system at ease. These are the words of people trying to stay ahead of panic. Meanwhile, everyday investors are being told conflicting stories. Inflation is supposedly under control, yet prices remain high. Rates are supposedly restrictive, yet debt continues to explode. Banks are supposedly well capitalized, yet require backstops and guarantees. This contradiction creates confusion, and confusion eventually turns to action. When action begins, it often flows toward assets that sit outside the traditional system. Gold tends to move first, quietly absorbing institutional flows. Silver follows with speed and volatility, pulling in retail interest once momentum becomes impossible to ignore. By the time silver is making headlines, the early phase is already over. This is why timing matters more than prediction. You don't need to guess the exact day or trigger. You need to understand the structure of the situation. A stressed banking system combined with an unstable bond market is not a temporary inconvenience, it's a structural problem, and structural problems don't resolve cleanly. As we move deeper into this cycle, expect more volatility, more surprise interventions, and more narrative shifts. One week it will be inflation, the next week it will be financial stability, the week after that it will be unexpected market stress. Each shift pushes the system closer to a credibility gap that can't be closed with words alone. This is where precious metals shockwaves begin, not with fireworks, but with quiet repositioning, not with panic, but with calculation. And once that wave starts moving, it tends to feed on itself. In the next part, we're going to dig deeper into why this stress is accelerating, how bond market cracks spread faster than most people realize, and why silver could respond more violently than almost anyone expects when confidence finally breaks. Stay with me.
What makes this moment especially dangerous is how fast stress can travel once it leaves the bond market. Bonds are supposed to be the palm center of the financial universe. They are used as collateral, as reserves, as benchmarks for everything else. When bonds stop behaving predictably, nothing above them feels solid anymore. Banks feel it first, then institutions, then markets, and finally, the public. Right now, bond volatility is no longer just about inflation expectations, it's about trust. When buyers hesitate, when auctions struggle, when yields jump even as demand weakens, that tells you something deeper is wrong. It tells you that investors are questioning the long-term value of holding debt issued by governments that can only survive by issuing more debt. That feedback loop is not sustainable. Banks are trapped inside this loop. On one side, they hold massive bond portfolios that lose value when rates rise. On the other side, they face depositors who want higher yields or immediate access to cash. If banks raise rates to keep deposits, profits get crushed. If they don't, deposits leave. Either way, stress builds. This is why central banks keep stepping in quietly. New facilities, emergency lending windows, relaxed rules, and backdoor support programs are becoming normal. Each intervention buys time, but each one also sends a signal. It tells the market that the system cannot function without constant support. Over time, that erodes confidence instead of restoring it. When confidence erodes, behavior changes. Investors stop asking how much return they can make and start asking how much risk they can avoid. That shift is subtle at first, but it's powerful. It's the difference between chasing yield and seeking protection. Gold thrives in that environment. It doesn't promise income. It doesn't need to. Its role is stability when promises start to feel fragile. Silver, however, plays a dual role. It's both a monetary metal and an industrial one. That combination makes it uniquely sensitive during periods of transition. When fear rises and policy pivots begin, silver often reacts with sudden force. What's important to understand is that silver doesn't move because everyone agrees at once. It moves because a small group moves early, liquidity thins, and prices gap higher before the crowd even realizes what's happening. That's why silver rallies feel chaotic. They don't give polite entry points. Another overlooked factor is how underprepared the market is for a precious metals move. For years, investors have been trained to believe that tech stocks, crypto, or real estate are the only places to protect wealth. Precious metals have been sidelined, mocked, or treated as outdated. That narrative leaves portfolios dangerously one-sided. When that narrative breaks, reallocations don't need to be massive to cause massive price impact, especially in silver. The physical market is tight, supply growth is slow, inventories are thin. When investment demand rises even modestly, stress appears quickly. At Silver Reset, this is the pattern we watch closely, not price spikes alone, but the conditions that make spikes unavoidable, and those conditions are aligning now. Bank stress removes trust, bond market cracks remove stability, policy confusion removes clarity. What remains is uncertainty, and uncertainty always seeks a hedge. What's also different this time is public awareness. People remember bank failures. They remember frozen accounts. They remember sudden rule changes. That memory lingers. It doesn't take much to reactivate it. One unexpected headline, one failed auction, one large institution in trouble, and sentiment can flip overnight. When that happens, precious metals won't politely wait for permission. They will reprice to reflect the new reality. And once they do, narratives will change fast. Analysts will explain why it makes sense now. Media will call it obvious, but the move will already be well underway. This is why watching official statements alone is misleading. By the time officials admit there is a problem, markets have already priced it in. The real signals are in stress responses, not speeches. Emergency tools tell you more than optimistic forecasts. As the system leans more heavily on intervention, the value of assets outside that system rises. That's not ideology, that's history. Every major period of financial stress eventually rewards those who positioned before the panic, not during it. Silver, in particular, benefits from being underestimated. It's small enough to move fast, liquid enough to attract attention, and emotional enough to draw momentum once it starts. That combination creates the kind of shockwave people only understand in hindsight. This doesn't mean the path will be smooth. Volatility cuts both ways. There will be pullbacks, noise, and attempts to downplay the risks. But volatility is not the enemy of precious metals. Complacency is, and complacency is disappearing. As bank balance sheets weaken and bond markets lose their anchor, capital has fewer safe places to hide. Cash loses value to inflation, bonds lose value to rates, equities lose value to uncertainty. That leaves real assets, and among them, precious metals stand apart. If you've stayed with me this far, you already understand that this isn't about fear. It's about structure. Systems under stress behave in predictable ways, and right now, the structure points toward a repricing of risk that favors gold and silver. Before we wrap up, I want to hear from you. Do you think the next major shock comes from banks, bonds, or something most people aren't even watching yet? Drop your thoughts in the comments. I read them, and they help shape future videos. If you found this breakdown useful, share this video with someone who still believes everything is back to normal. Sometimes one conversation is enough to change how people see risk. And if you haven't already, make sure you're subscribed to Silver Reset. This channel is about seeing the shift before it becomes obvious, and what's coming next will matter more than most people realize. Stay aware, stay prepared, and I'll see you in the next one.